So Lucia, when do we see? I mean, we just started 3, right? I mean, 3 my time, and we assume. I mean, that's when the audience is there, right? Or do we see anything change on the screen? No. We're on now. Okay. Okay, let's take a couple of minutes to allow everyone from the audience who wants to join this webinar to join. I think we still have about 2 minutes.
Yeah, I think you already have about 34 participants. Thomas.
I've just seen that. Okay, that's great.
Yeah.
All right, welcome to this webinar, which will address the impact of COVID on the insurers in the Eastern and Southern Africa region. This webinar is part of a series of webinars that FSD Africa is hosting in partnership with Cenfri, and which address the conclusions and themes from our joint research on how the pandemic is impacting the insurance sector in Africa. The first webinar, which we held a few weeks ago, considered digitalization during COVID-19, and the second webinar recently addressed emerging issues regarding the longer-term sustainability of the industry. Today, this webinar, we are focusing on the results of a survey that we conducted in partnership with OESAI, the Organization of Eastern and Southern African Insurers. We surveyed the members of OESAI to understand the impact that COVID-19 is having on their operations, what they see as major challenges and opportunities arising from the pandemic. We also conducted in-depth structured or semi-structured interviews with several insurers and associations and brokers and other stakeholders. As we all know, COVID-19 is having a significant impact on all sectors of the society and economy, and the insurance sector is no exception. Across many countries on the continent, insurers are facing operational restrictions as a result of social distancing regulations. Furthermore, the economic crisis and its disruption to trade, global supply chains, individual businesses, transport, and so on, is forecast to reduce GDP by between 2 to 5% across the continent this year. Insurers, therefore, have been hit by the double challenge of having to rapidly adapt to an environment of remote work and the economic and social crisis among their existing and potential customers is severely impacting their revenue and bottom line. However, we also think that with any crisis, there comes opportunity. So today, based on the findings of the survey and our telephone interviews, we will address the challenges of the moment, but we will also discuss with an esteemed panel what the opportunities are that we are seeing during and after this pandemic. I'd like to welcome my panelists, which we're really glad that you can all join this panel. So first we have Dr. Grace Muratsikwa, who serves as the Commissioner of the Insurance and Pensions Commission in Zimbabwe. She has more than 35 years experience in the insurance industry. Welcome, Grace. Second, we have Mrs. Hope Murera, who is the Managing Director of Cenfri, a Pan-African reinsurance company that serves Africa and is headquartered in Kenya. Welcome, Hope. Thirdly, we have Ezekiel Macharia, who is the Chief Actuary and Managing Director of Kenbright Holdings, which provides brokerage, healthcare administration, and actuarial services to East African markets. He's based in Nairobi. Welcome, Ezekiel, to the webinar. And fourth, we have Darlington Chamburuka, who is a financial actuary at Old Mutual, which is a Pan-African investment, savings, insurance, and banking group based in South Africa, but active across 14 countries on the continent. Before we begin the discussion, I would like to recognize the excellent partnership that we have with the Organization of Eastern and Southern African Insurers. Mrs. Lynette Macharia is the Secretary General and CEO of OESAI, and I invite her to give a short welcome and introduction. Please, Lynette.
Hello, everyone, and welcome to today's session. Thank you very much for making time to join this webinar. Thank you very much, Thomas, for setting the scene. As you've all heard from Thomas, OESAI, in partnership with FSP Africa and Cenfri, has in the last couple of weeks conducted a study on the effects of COVID on the insurance sector in the sub-Saharan Africa. This process has birthed this webinar event, which forms part of a series of roundtable events that OESAI plans to host through the course of 2020. All this geared towards stimulating discussions and eliciting bold ideas as to what challenges and opportunities there are for the sector looking into the future. As an industry, our role is to work together to support and build more resilient societies. I'd like to say a big thank you to our members in the African insurance fraternity for taking part in the survey and the telephonic interviews that we conducted. I'm excited for us to unpack the findings of this study together, led by our expert panel. And one of my expectations today is heavily skewed towards opportunities and solutions. These catastrophic events like COVID can cause massive economic disruptions, and therefore the time has never been better for us to have this conversation. The World Bank estimates that COVID-19 will push 71 million additional people into extreme poverty this year. The pandemic has therefore exposed protection gaps more significant than has ever been quantifiable before. There are currently various discussions globally around the pandemic and natural catastrophic risks, and how the insurance sector has a unique contribution to make by offering solutions through products. It's obvious the low levels of penetration rates we are looking at in the continent, and this is partly due to unaffordability of insurance. Having been part of these discussions myself, it's clear that despite the immense challenges there is political will from most developed countries through their development financing institution to support and build resilience in emerging economies. As one of the main channels that has been looked at the moment is insurance, all of us agree that we need to create attractive products around pandemic risk and of course other natural catastrophic risks. That can be supported through private public partnership programs where government and DFIs assume a substantial percentage of the risk and therefore make insurance more affordable to the public and of course business owners who have really been affected during the pandemic. As insurers and reinsurers, I understand it's in your best interest to manage expectations with respect to what's possible given the complexities around business development and the need to understand the risk better and of course subsequent modeling capabilities available. However, I must say the reputation and the capabilities of the insurance industry is right now being put to test. So is the industry playing its role in your view? I believe the ball is in our court, so let's see how we can push that needle. Once again, thank you for making the time to join the webinar. The final report will be made available to all our members, and hopefully this document will be a solid resource even as we strategize and carve out business plans for the next few months. I think at this point I will give it back to Thomas to take us through the rest of the webinar. Thank you.
Thank you very much, Lynette. So let's start. We will have this webinar structured in 3 segments. The first one dealing with the immediate impact that the insurance sector is experiencing right now. The second one dealing more with the longer term, medium to longer term impact and concerns. And the third one, the third segment, we will talk about some challenges and opportunities. During each of the segments, we will run a quick poll with Zoom's polling function. So you will see that popping up on your screen. And if you feel like, please respond to that poll. Also, please make use of the Q&A function. We are going to take up a very limited number of questions at the very end of the webinar. But please, just write whatever question you may have and whatever issue you would like to see addressed by the panelists. Okay, the first segment. Okay, before we go into the first segment, just a quick overview. So we ran this survey as an online survey and received answers from more than 60 organizations. The majority of these, almost 80%, were insurers and reinsurers throughout Eastern and Southern Africa. And we also had a substantial number of insurance associations and companies that self-identified as either microinsurers or insurtech firms responding to the question. So this is the basis on which the further slides you will see during this webinar. I mean, this is where the numbers are coming from. Okay, next slide. So the immediate impact impact that the respondents are seeing right now during this pandemic. Next slide. So the current impact of COVID-19 on operations of insurance companies. We are seeing a very significant decrease in premium collections and in new sales. Almost around 2/3 of the respondents are saying that premium collections and sales have virtually collapsed. Some of this may be due to premium holidays, but nevertheless, this is revenue which is not being collected at the moment. There's also a quite significant reduction, about 45% in renewals, which may be as a result of especially corporate customers not renewing or significantly reducing the coverage that they buy. At the same time, lapses are increasing by 41%, so non-payment of current or running insurance policies. And there's a significant increase in customer queries, which very often relate to queries about the extent of coverage, the processes through which to file claims, etc. What we're also hearing from the respondents is that about 50% of them are expecting premium incomes to recover within the next 6 to 12 months, which is, of course, on the one hand, very optimistic and promising. On the other hand, it stands to be seen how the pandemic progresses and whether this projection really becomes a reality. Next slide. We also asked during the survey about the regulatory response that the respondents are seeing or that they would like to see. The responses can be structured broadly into 2 categories. So the first one are responses that help with adapting to the new operational reality. So, for example, some regulators have either approved or to some extent asked for or mandated collection holidays. 46% of respondents have seen this, the flexibility in terms of premium collection periods. Several regulators have also allowed e-signatures and e-KYC to facilitate conclusion of new policies, sales, etc., during the social distancing regime. The second category is adjustments to the supervisory and reporting regime. So this has happened to a lesser extent, but still there's a considerable percentage of respondents who wish to see such adjustments. I find it notable that about 30 to 40% of the respondents would like to see a relaxation of prudential requirements, which in my opinion could point to an arising challenge when it comes to fulfilling these prudential requirements. All right, so my first question goes to Darlington. Darlington, I would like to start with you and ask you whether, as Old Mutual, a Pan-African insurer in 14 countries, what is it that you have seen so far? And considering that this data paints a quite bleak picture of the current outlook for insurance providers, does this data resonate with your experience at Old Mutual? How has Old Mutual's business operations been impacted by COVID-19, and have there been any major differences across the countries that you operate in?
Thank you very much for the question. Sorry, I was muted. So the slowdown in the economic activities across our market has actually affected our renewal and new business. So I think I agree with the data that you've actually presented. In some countries, the renewal rates in terms of the policy count is high, but when you consider the renewal amount in terms of the amount is lower because some of the customers have actually reduced their covers. And we have actually responded to the plight of our customers by allowing them to reduce the cover during the lockdown. We actually expect the consumers to remain under pressure because of the increased unemployment that we've seen across all our markets. Premium collection is under pressure, as some customers who used to pay annual premiums are now opting for quarterly and monthly payments to manage their liquidity position. The claim experience is actually mixed. We have actually seen an increase in COVID-related claims relating to business interruption claims. However, in the markets like East Africa, where we operate, we have actually seen medical claims on the decline because the governments, they have taken the responsibility of COVID-related claims. In the first quarter, we saw the motor claims declining, but when the economies were opened again, we are now seeing an uptick in the motor claims. Thank you very much, Thomas.
Thank you, Darlington. Ezekiel, let me ask for your experience. Is there any change you have seen in corporate clients' ability to pay premiums and renew policies? Taking into consideration how the consumers have been impacted by COVID, do you think it's likely that premiums will recover within the next 6 to 12 months, as a significant number of respondents have indicated?
Thank you, Thomas. It is true that consumers are actually reducing coverage. And one thing we've seen is that there's a request from insurers, from our actuarial side, to do product development, to see whether we can develop products that can actually suit the new way of life. For example, having a vehicle insurance that you can pause. Also looking at, for people who did cover COVID, whether they can have a COVID-only cover. But all that obviously rests on how fast the regulator can approve some of these things. We've also looked at insurers coming to look at stress testing to see whether they can stress test whether they can afford some of these proposals that they're having. And my final statement would be also, when you're doing new products for the clients, is that the reinsurance is very key. So as the product's been developed, you'd find when the seeded premium is a lot, the reinsurer really comes into play and really can support the product development of the seeding company. Okay,
so Hope, reinsurers. as Ezekiel has indicated, are key here. Cenfri is a regional reinsurer in Africa. Has the reinsurance industry already started to feel the impacts of COVID-19 on its operations? And if yes, what types of impacts are you seeing or have you seen as a reinsurer?
Thank you, Thomas. Yes, the fortunes of reinsurers mirror the insurance companies and the industry. And as you've heard, this has been a double-edged sword. On one hand, there's reduced business, both renewal and new business. There's lower collection, yet there's increasing claims. So this is also impacting reinsurers. It means that liquidities are being impacted. It means that both top line and bottom line are being impacted. We've also seen premium holidays, like somebody has said. And then we've seen pressure from regulators to have insurance companies pay claims and sometimes stretch the policies in terms of what is not covered. So it has not been a very good time for the insurance industry. And we've seen, of course, in the past that the industry mainly relies on investment income. So when we have the equities market crashing and bond and real estate crashing, the insurance industry is getting the hit. And you can see this from the downgrades that have happened in the recent months at both regional and global level.
Yeah, we will talk a bit more about investment income and what it means for liquidity and solvency in the next segment. So Grace, you are the regulator, and IPAC is responsible for regulating insurance and pensions industry in Zimbabwe. A substantial number of respondents have indicated that they would like to see a less burdensome reporting requirement, and maybe even a relaxation of the prudential requirements, and in fact a faster approval of new products. These are quite some expectations, or let's say at least wishes. What are your thoughts on these requests?
Thank you, Thomas. I appreciate the concerns, coming from the industry, having been that side myself for many years. I guess the last thing that anyone wants, when you're trying to deal with a crisis is frequent requests, for information, from regulators. But, having said that, COVID-19 pandemic must be appreciated, for what it has done. We are in a time of crisis. These are not normal times. And it calls for vigilance, on the part of our regulated entities. It's also calling for vigilance on the part of regulators. And it has completely disrupted, all conventional ways of doing business. It has forced radical transformations, not only in the business processes itself, but even in terms of social organization. And in this environment, change is being forced on all of us. So I'm aware that regulators across the globe are endeavoring to keep in touch more often than would otherwise have been normal and offer guidance, to the industry. We want to be part of the solution, not the problem in response to the crisis. And I'm sure, my fellow regulators, would share and agree with me on this. Due to the lockdown and movement restrictions as well, most regulators have shifted their supervisory approaches, from on-site inspections, to off-site, which is remote supervision. And that has necessitated increased requests for information to inform regulatory interventions and also policy advisory. So in my view, what is needed here is more conversations with regulated entities to understand why certain information requests are being made. I'm personally convinced that most of our regulated entities will appreciate, these requests for information. And in the context, I think, of Zimbabwe, less burdensome reporting and relaxation of prudential requirements may also have an adverse effect, on the confidence levels on the industry, given that, the industry has gone through various periods of loss of value. And most of these additional requirements, in terms of reporting and just need for more robust prudential requirements have been informed by lessons, that we've drawn from prior experiences. With respect to product approval, though we are largely working remotely, The Commission, we now have a licensing committee and we stand ready to approve products. We have not seen an increase in product approval requests at all. Our average turnaround time is about 14 days to approve or disapprove a product, and provided obviously all the requirements have been submitted. I think finally going forward, what will be helpful, I think, is for regulators to also share their product approval frameworks with the industry, and so as to streamline, some of these processes. Thank you.
We'll take one question from the audience, and there's a question by Judith Nekesa, who is asking about essentially about risk-based regulatory frameworks, which are obviously meant to take into account risk within the industry. And there are inherent risks, but there's also emerging risks. And I think definitely COVID qualifies as an emerging risk. Grace, maybe you can speak to that. What's your view on risk-based supervision in the context of this still somewhat unclear and emerging risk of COVID?
Yeah, I totally agree. I think markets need to quickly adopt and move to a risk-based supervision, and which obviously encompasses, your capital requirements, which will reflect the risks which are inherent in each business undertaking, as opposed to having a one-size-fits-all in terms of minimum capital requirements. And, in Zimbabwe, I think if we have participants, coming from this market, they will be aware that we're actually working, very, very fast towards implementing a risk-based capital framework. And we are hoping that by the end of this year, we'll be able to do that. So I totally agree. I personally do not subscribe to a one-size-fits-all. I think capital requirements must reflect, the risks which, each business and management and boards and shareholders, are willing to assume. I don't know if that's helpful.
Yeah, thank you. So let's move to the second segment of this discussion. This segment concerns the current and long-term concerns that the respondents are having when it comes to this pandemic. So on the next slide, we show you a snapshot of these responses, and I think the key background here really is that already before the crisis, many African insurers were struggling to make an underwriting profit. Other research that FSD Africa and Cenfri has done did identify that many were actually relying on investment income for their profits. Over 80% of the respondents are concerned about their investment income and their ability to control operational expenses. These are the first two bars to the left of the figure. Expense ratios actually were already very high before the crisis, but obviously they cannot fall to the same degree as claims costs are falling. And in fact, in some cases, actually, the expense ratio might have increased during the crisis because of this. The other three bars of the figure point to the fact that if this reduction of investment income and the operational expenses are not controlled, this will ultimately lead to liquidity and solvency issues. And our research shows that about 60% of the respondents are very, or at least slightly concerned about meeting minimum capital requirements. And again, background here is that already before the crisis, there was a significant portion of insurers, and to some extent depending on market, of course, but across the board, a significant number that were barely fulfilling these requirements before. So in this regard, let me ask the first question to Hope. Hope, this data shows a stark outlook for the African insurance providers. Are you concerned about the sustainability of the reinsurance industry in Africa? And with decreasing premium and investment income, are liquidity and solvency a concern for reinsurers right now?
Yes, Thomas, there's need for the industry to take stock. It's not just about reinsurers, it's about the regulators as well. It's about the insurance companies, and really get back to basics. We have to make profit in our core business. I think that one can't be said loud enough. For example, in this market in Kenya, Ezekiel will confirm, for the last few years, there's not been an underwriting profit. So that in itself is not sustainable, because investment markets are volatile. We've seen the economic shocks over the years, and we need to learn from that. And so we've seen the equity market collapse. So we have to get back to what is the problem? What is the structural problem within our industry that, makes us make losses in the core business that we do? Is it pricing? Is it undercutting? Is it, less penetration? We need to deal with that. And the answer lies in all of those. So there's been so that is in a way positive, that we will need to take stock. We need to step back and take stock. We can't not do that. The other point that is in a way positive also is that COVID has forced us to look at the investment we've done in technology. I mean, that's the way forward. And the insurance industry was well behind the banking industry, for example. And for us to develop new products, the innovation, to reach more and more of our people, to make insurance more relevant in terms of social inclusion and financial inclusion, we need to go digital. So most of the companies, of course, were not ready. I'm happy, and I've seen that journey in the last few months. Many have gone online and are able to do that. So the future of the industry will mean us sitting together and relooking at what is it that is what is ailing the industry, right? The solvency and the balance sheet strength that the regulator talked about is very critical, because that is what brings the confidence. That's what brings us get better ratings. That is what allows us to innovate and expand. Yes, so those are critical issues. I think we'll come through, but we need to take stock.
Thank you, Hope. Ezekiel, Kenbright, your company works with insurers and in fact advises them on several issues. Your partners and your clients, what do you think are they most worried about at this juncture in time? And the data I've shown, does this resonate with you?
Yeah, thank you, Thomas. I think I really want to mention the issue of solvency. You have to remember that in risk-based capital regime, the solvency is made up of your available capital, which can be affected by your reduction in asset values, and also your required capital. Now, one of the biggest drivers for required capital is your uncollected premium. So uncollected premium really hits you, especially premium not collected after 30 days. That really affects you as an insurer, so that now your capital requirements is increased. And also having reduced asset values or interest rates can also affect in the actual world, what we call the discount factor. So if you're doing long-term insurance, you might find that you're discounting at a lower interest rate, your liabilities, which means that you end up having a higher capital requirement. So on one hand, you have your available capital dropping, and on the other hand, you have your required capital increasing. So what that does is that your solvency can actually go below the minimum capital requirement of 100. And it is very critical that regulators look at how they can support insurers at this stage to ensure that even if the insurers go below 100, this is more of a stress test position as opposed to a normal day-to-day item. On the issue of operational expenses, I'd also like to mention that if you see insurers reducing their revenue, some have reduced revenue even by 40–50%, and the expenses have not gone as much down, even if they've done some salary reductions. Salaries, employees' costs are only about 30–40% of the total expenses of an insurer. So on one hand, you have your revenue reducing, and the other hand, you have your expenses not reducing as much. So your operational expenses get hit. Now, if you're a small insurer, that may mean your expense ratio moving from maybe 20% to 40%. And even if the claims reduce, that can really affect you significantly. So we've seen that issue coming out in terms of the impact, especially on the revenue reduction and the investment return piece. And we've really seen that when we do stress testing, some of the insurers are really struggling to move along in the market.
Thank you. Very insightful. Grace, when you look at this data and you see that many insurers are concerned about their liquidity, their solvency, their investment income, and in fact, even maintaining minimum capital requirements, I think that's quite a clear early warning sign for regulators in your country, but probably in all the other countries across the continent as well. How do you think regulators should and in fact can respond to these concerns to ensure that the industry is still able to adequately protect consumers and remain stable? Is there anything that regulators could do or should do to proactively prepare for a scenario for seemingly likely prudential challenges among their licensed entities?
Thank you, Thomas. The one good thing that I'm liking about my position is that you have a helicopter's view of the industry. And I think as regulators, you are expected to see the early warning signs from a vantage point. And you are therefore able to issue warnings and direct entities to take corrective measures. You know, the regulator's interest, I think let's appreciate the regulator's interest, you know, in markets is the ability to build resilience and sustainability, you know, for the future. And for instance, I think just the need to align your revenues to expenses, I think that Darlington referred to. You know, for me, I think it's quite key, and it calls on leadership. You know, it calls on the leadership to actually see that my revenues are declining and I need to align my expenses. You know, we have received some weird requests, you know, from some pension funds, for instance, to reduce pensioners' payouts. And obviously, our immediate response was, what have you done to manage your expenses? Have you reduced your own salaries? You know, so for me, I think it really calls on leadership, you know, to take measures, you know, to protect, you know, policy holders, you know, in the wake of stressed revenues all around. The need to defer dividends payments, for instance, you know, to conserve capital, you know, I think entities should be making some of those considerations. And I'm aware of markets where regulators have actually directed that regulated entities defer, you know, the payment of dividend. We haven't come to that yet. You know, we have also noticed that most companies have incurred significant expenses to adjust to the new norm, you know, of remote working, social distancing, and many have incurred significant capital expenditures, you know, which have affected their liquidity position. You know, that's expected. And so you would also expect, I think, leadership for you to take that into account. And for me, I think regulators may also need to encourage optimal diversification of investment portfolios, you know, to hedge against underperformance of certain asset classes. I think it's also important to note that regulators are creatures, you know, of government, and are in a better position to inform policy advisory. And in times like this, they can also influence, you know, policy direction. You know, for instance, you know, in Zimbabwe, you know, we've just witnessed the closure of the Zimbabwe Stock Exchange, and we have also had some mobile money transfer reforms. And the regulator can be the voice of the industry, you know, in times like this, and lobby on behalf of the industry. So it's also important for the industry to be continuously engaging with your regulator so that the regulator knows, you know, what you're experiencing and how the regulator can also step in, you know, on your behalf. I'm just wanting to throw this, and I know it would be difficult for a lot of African governments, but discussions can also be made, you know, maybe initiated with governments around whether government can bail out insurance companies. You know, I think we've seen some of these developments in some of the developed economies, but it's also a consideration. So I think for me, I think there's a lot that the industry can do, you know, if they are working together with their regulators, and especially when the regulator understands, you know, what they are experiencing. I think we all want a vibrant industries. We are all wanting to see the industry coming out of this, you know, well. I hope that's helpful, Thomas.
Yeah. No, thank you very much, Grace. Yeah, I think, I mean, in some countries, there's actually a mixed experience in some countries regarding whether insurance is an essential service. Yeah, so I know that some countries have declared insurance as an essential service, and this has allowed insurers to continue operating even during a lockdown. I mean, operating physically, yeah, with staff at the office, etc., during a lockdown scenario. So, and the other point I wanted to make is that, and it's probably a bit too early to really say whether that we will see consolidation in some markets, consolidation in terms of number of insurers, either insurers going out of business or merging with others. But if we were to reconnect in, let's say, 6 months or 12 months time, we might actually know better whether that is happening or not. And in fact, in some countries, that was a process that was already ongoing and happening before. Darlington, when you look at this, slide and this data, it's clear that insurers are very concerned about their future sustainability, and to some extent, they were probably not very well prepared for a global pandemic, which then has turned into both a health and an economic crisis, with obviously severe impacts on insurers, both operationally as well as prudentially and regarding their claims experience. What do you think are the lessons that insurers can learn and should learn from this, and how can they prepare better for future crises? Also looking beyond health events, but looking at natural disasters, climate events, and indeed other pandemics which we might see.
Thanks, Thomas. Yeah. So though the insurance industry is usually prepared for pandemics and large claims through the arrangement of reinsurance, most of us would agree that we were not prepared for COVID. And actually, to make matters worse, the full impact of COVID has not been felt. It will depend from country to country, and it will depend with the recovery period. But the impact of COVID on each insurance company will depend on 5 things. The first thing is it depends on the reserving philosophy. We actually expect most products to increase their IBNR reserve, which is incurred but not reported reserve, as some people may not be reporting on time during this lockdown or the slowdown in the economy. The second impact will depend on the class of business, the insurance company, right? So if you are exposed to businesses like retrenchments, business interruption, you would actually see claims on that side increasing. So what we actually expect is that we expect some insurance companies to start decreasing their exposure to those kind of classes that is prone to COVID. The third thing that would differ from company to company is the asset mix. So companies that have got high exposure to equity to maximize the return has been severely impacted as most of the equities is actually declined. So we actually expect the companies now to start to move towards to a better asset liability mix that talks to their liability, and also that also reduces the market risk. The fourth one is on policy wording. The policy wording is interesting in the sense that sometimes the perils that we think we are covering as the insurance industry is different from what the clients think they're being covered. A good example is on the pandemic, where the insurance companies are saying that you are covered if the virus has actually affected your premises. So you need to prove that you've actually closed down the premises because of the virus, not because of the government lockdown. So I think there is actually an opportunity for the insurance companies to be clearer on their policy wording and to reduce the gap between what they think they're covering and what the policyholders think they are being covered for. The last one is on the reinsurance arrangements. For companies that have actually got the reinsurance arrangements that talk to their risk appetite, they will list they were less affected by large claims because the reinsurance companies are picking the large claims. The companies that were taking more than what they can chew and not reassuring in terms of their risk appetite are seeing a big impact. So those factors will affect company from company in terms of their experience. Thank you, Thomas.
Thank you, Darlington. Thank you very much. So this is actually a great segue into our next theme, which will talk about the challenges and opportunities that are arising from this pandemic and from this crisis. So the first slide I want to show you are the results of the survey as regards product inclusions. So this is really basically about to what extent insurance coverage helps people and businesses to deal with this new type of risk, and how insurers are doing this or not is really a challenge and an opportunity at the same time, because the risk is so large and unprecedented that it is a risk, an actuarial risk and then an operational risk for the insurers, but it's also an opportunity to really demonstrate the value and the relevance of insurance to their clients and also to potential clients. So on the left-hand side of this figure, you are seeing responses to the question whether COVID-19 risks are covered in existing insurance contracts. And we do see that, I mean, at least for life and health risks, there is a significant number of policies that do actually include pandemic risks, yeah, or are at least not clear about it. When it comes to business interruption and event cancellation, a lot of current policies are already excluding coverage for pandemic risks. On the right-hand side, we dug deeper and asked, so if your policy or the policies that you're offering are neither including nor excluding pandemic risks, what was your response as an insurer? And for life and health policies, the majority of insurers actually decided to include coverage for pandemic risks. When it comes to event cancellation, we see, to business interruption, we see quite the opposite picture. And the majority of insurers, 79%, actually did decide to exclude it. In some, I've had some discussions with insurers which actually pointed to the fact that their reinsurance contract were almost compelling them to exclude that, because reinsurers were not willing, or actually had excluded this from their reinsurance arrangements with primary insurers. So I think that's these are points that came up in the earlier discussion. But nevertheless, let me ask a question first to Ezekiel. Sorry, before we do that, actually, there's a second slide I want to show you. And that is the other theme which we see strongly coming out of this survey, and that concerns digitalization. So with the new operational reality of COVID-19, there's a need to do more work remotely and digitally. And our survey has identified that about 66% of the respondents are digitizing their operational processes. And the key area of work here really is the sale of new policies, which is the first bar in the figure. So only 19% of respondents were able to sell policies digitally before. 60%, roughly 60%, are now working on or have already concluded developing that capability for their organizations. So with these two themes, product inclusions and digitalization in mind, Ezekiel, what have been your customers' biggest concerns about business interruption insurance? And COVID-19 has highlighted a clear customer need and gaps actually in coverage of the current offerings. What advice would you give to insurers based on your experience and what you're seeing in the market? also in regard to digitizing aspects of their value chain and their operations?
Thank you, Thomas. So the first thing I want to mention is that the wording on pandemic in some policies was silent, and that produced what I call an operational risk, because you'd find the reinsurance contracts would exclude pandemics in some cases, but the insurer may have forgotten to put that wording in. So you're seeing a lot of legal disputes on that, and then that is also affecting the renewals of the clients because they feel that they don't have coverage anyway, because everything can be looked at as a proximity risk on COVID, and it can be a COVID-related claim. So that has really affected the renewal items. And then on the issue of digitization, we have seen that the insurers are digitizing on the enrollment part, but on the fulfillment of the claims, there is limited digitization. Why? Because in some indemnity products, the insurer maybe is dealing with third parties who are not digitized. For example, health insurers might be dealing with hospitals, which some of them are not digitized, so they can't fulfill the whole journey, quickly on digital. Like motor insurance deal with people like garages, who some of them are not digitized. So the claim process to the consumer might not be as digitized as they want. So if you look at the chart you just shown, I would say more on the selling of the policy, on the collection and the issuance of the document. That process, I think, has been well looked into. But now the issue of servicing, processing of claims and paying of claims, there I would say there's a bit of a challenge in terms of making it an end-to-end solution. As ourselves as Cenfri, we've also come up with an aggregator portal, which we're trying to work with insurers to see if we can white label for them. And we've seen good uptake. It's a motor platform. And in Kenya, the good thing is that we have M-Pesa, which is a mobile money, and we also have digital motor certificates. So you can actually fulfill the motor insurance journey remotely with the user. However, the challenge now becomes, now once you've told the client they can do everything online, now on the claim side, they might be frustrated because now the manual nature of claims processing and insurance wordings come in, and that can really frustrate clients.
Thank you, Ezekiel. Hope, it's clear that many insurance product policies do not cover pandemics. And then it's also very often said that global pandemics are actually too big of a risk for the insurance and the reinsurance industry to cover. Do you think it's actually possible for the industry, insurers and reinsurers together, to cover future pandemics? And if yes, how do you think the industry could go about doing this?
To start with, I think it's been unfair on the industry to expect that we needed to deal with the issues that came. I mean, no one knows the impact and the extent of COVID. So challenging insurance industry to deal with this issue is not possible. It is a multifaceted, it's an extensive, very impactful event that we all need to put our heads together to find a solution. Insurance industry does provide a component of this. I mean, we know how to put together products. We know how to model as data comes through. We know how to manage the whole infrastructure of service providers and claims payment. But like you say, the capital required to handle a pandemic is not something that the industry can deal on its own. And because there are many efforts around that, it would be better if they were brought together. I mean, if you saw African Development Bank, for example, raised a 10 billion or so bond on COVID. We've had governments do other things. So why not bring all this together? And we need to do that because when you see the history of epidemics, it will take 50 years between, for example, the Spanish flu and the Asian flu and whatever flu that happened. But if you look at the last 10 years, it's practically every 2 years, right? So we need to find a solution. It's impacting the social fabric. You've had the World Bank numbers around how many people are falling below the poverty line again. 65% of the impact alone is based on the lockdowns, the economic impact of that. So yeah, so the solution needs to lie in private-public partnerships for sure. We've seen successful examples. We've seen the Africa Risk Capacity, for example, to deal with the issues of drought. We've seen a catastrophe pool in the Caribbean that has done very well. And this is the part that we all need to come together to do that. We will play our part, for sure. I can't say that we will not do that. But today, we didn't collect premium for pandemics. We couldn't even have a structure that, because we didn't know about it. We don't have, no one knew how, we don't even know up to now how it is passed around, right? Is it now airborne or not? Yeah, so it is a much bigger problem. I think we all have to come together, and yes, the industry will do its part. We can manage those pools. So we've actually proposed at the COMESA level creating of a regional pool, a multi-country pool, so that the resources are pooled together. And because private sector is better at dealing with the resources and structuring things like that, we could bring in the industry to manage that. But the countries and the donor community can bring in the resources, and I think then we'd have a solution.
Yeah, in fact, I can say that, I mean, for climate risks, the donor community and the development agencies have been quite active in partnership with the industry on that. And for agencies like us, I think this pandemic is also a wake-up call to see what we can learn from the natural disaster risk pooling, and maybe bring to public-private partnerships for health risks. Darlington, we've spoken a lot about the challenges facing the industry, the insurance industry, but in the times of crisis, there's obviously also always opportunities. Although there have been transitional challenges, our data from the survey shows that this crisis has also triggered at least thinking and, in fact, a lot of action on digitalization across the value chain. So putting these things together, what do you see as the greatest opportunities emerging for African insurers out of this pandemic?
Thank you very much. So COVID-19 has actually highlighted the need for the insurance companies to streamline, digitalize their operations. So there are about 5 opportunities which digitalization would bring to the insurance industry. The first one is time and effort. Most of our customers actually want access to information for them to make a decision about buying an insurance product. So digitalization actually makes it easier for customers to access that information and make an informed decision on their own. In terms of COVID, we've actually seen more cry on personalization of the products. So customers want our solutions that talks to their individual circumstances. For example, there are customers that are saying that I don't drive my car, so I would want a cover that talks to the fact that I don't use my car a lot. So digitalization allows us to come up with the solutions that are more personalized. Similarly to the theme of personalization, we've also seen the demand for usage-based insurance, which is similar to the example that I have given. So there's actually an opportunity for the insurance industry now to design products that are based on the usage. Then on the e-commerce, although most of the insurance companies have tried to sell via the digital, we've actually seen the demand for being able to process everything online. So companies that are able to start to finish the online processes will win in the war in the digitalization. Then the last opportunity is around the new channel. So digital allows us to access customers that we normally don't reach through the traditional channels. Thanks, Thomas.
Thank you, Darlington. Grace, last question to you. The data from the survey indicates that many insurers are starting to digitize. their operations and yeah, the entire value chain actually. So what is the role of regulators, in your view, the regulators in Africa, to proactively support insurers to innovate?
Okay, thank you, Thomas. Look, apart from prudential regulation and consumer protection, most regulators have a mandate to encourage market development, and growth. And most governments are also desirous, to see penetration ratios and pension coverage ratios, actually going up. And in my view, the insurance industry has been very slow to innovate. In fact, I'm surprised with these statistics that 66% of respondents are digitizing their processes. I expected 100% because I do not see how you can survive if you are not digitizing. So my expectation would have been actually to see 100% of all respondents saying they are frantically working towards digitizing their processes. So with the COVID-19 pandemic, innovation and digitizing, it's no longer an option. It has to be a survival, a strategy. And, from where I sit, I'm seeing lots of opportunities for the industry to innovate. There should be innovation around distribution channels. There should be innovation around product profiles. I totally agree with Darlington that the needs of policyholders have changed. Business processes have been remodeled, and so one would expect, I think, a deeper understanding of the future needs of clients and products that are speaking to those new realities. And also with the growth of the informal sector, the opportunities for micro pensions, for non-standard workers, so the COVID-19 push for digitizing, it's an opportunity for insurers, pension funds, to improve their customer records, and maybe to make sure that those customer relationship systems, which have been gathering dust, we really get them to work now. Maybe CRIMs, that are linked to your communication channels, the use of text messages, WhatsApp, Facebook, social media strategies. I mean, I do see a lot of opportunities for innovation. I accept that we've been slow as an industry, but I think the time to do this is now. And if we are unable to do that, I actually think that it's going to threaten, our survival. And so your question specifically is, what can we do, as regulators? I'm aware that most of my colleagues, and I also speak for IPEC, we have been extending flexibilities, to allow for responses, to the new ways of doing business, allowing for electronic policies, electronic signatures, also allowing for e-filing of returns. And we have also intensified our discussions, with other regulators, so that we just share experiences, from other jurisdictions, and exchange, some learnings. Perhaps one might also consider establishing research and development units, innovation hubs. I know a lot of universities, some companies, they put innovation hubs, and those are the kind of things that we like to encourage. Maybe lastly, just speaking for the Insurance and Pensions Commission, and we had done this even before, COVID. The COVID-19 has actually slowed down our processes, but we had actually approached Cenfri, and we were exploring the potential for collaboration, on the implementation of a pro-innovation regulatory framework. We believe that, Cenfri has done a lot of work on the tools and models, which can be made available to regulators. And this is something that we were already working on. We are aware of the work that they've done around regulatory sandboxes, which are controlled, test and learn approaches, to regulators in developing countries to encourage innovation in their markets. The issue here being that while innovation is key to market development, we also must appreciate that some innovations are very risky, and hence the need, for regulators also to ensure consumer protection is not compromised. I think a case in point, which some of you might be aware of, is the EcoLife product, in Zimbabwe. So we need to make sure that as regulators, when some of these products, are being presented, for approval, we have protected, consumers, and hence, why we had extended, to Cenfri and other development partners, for assistance, just around developing the regulatory framework for innovation. Thank you.
Thank you, Grace. Thank you. So I know we're running slightly over time. I would like to take maybe one. Yeah, I think we have time for one question from the Q&A. There are a few questions, so I'm not going to pick just one, but there are at least 2 or 3 questions around the business interruption coverage, which I think, correct me if I'm wrong, really speaks to how useful is insurance and how could it be more useful for businesses, for corporate customers in Africa. I don't know if one of the panelists, maybe 2, would have a few thoughts on this, how to address this issue that business interruption, as the data has shown, in many cases actually excludes pandemics. But what could be done to make it more, useful and to some extent reorient the insurance industry to provide useful or relevant coverage? Who wants to say a few words about this?
I can go.
Yes, please.
Thomas. So yeah, somebody had actually asked me that question on the chat, and as you know, it's actually in courts in some of the jurisdictions. So yeah, we ought to be limited in the conversations we have around that. But it is true. It also gives an opportunity to make sure that we not only simplify our wordings, our cover notes, but also align, because that has been an issue as well. What is covered, what is not covered. But the truth of the matter is that the insurance companies were not ready, or the insurance industry wasn't ready to cover the BI arising out of COVID, especially where you're having economic lockdowns that are government instituted. So I think currently that really is the position that the BI on most cases is not covered. That is the position of the insurers, that's the position of the insurers, and I think that's the correct position. So going forward, what is the solution? We always do come, there's always, like the theme of this conversation, there's always an opportunity. We've seen the industry now cover terrorism. That was something that we didn't cover before. It's always a matter of the availability of information. And then I think going forward, we're going to be structuring, we'll be seeing more structured covers that maybe have some limited level of involvement. Yeah, that's my thought.
Thank you, Hope. So with that, I would like to conclude this webinar. But before we close, I'd like to point you to a report that we have just published about dealing with this question, how sub-Saharan African insurers are being affected and are responding to COVID-19. So you see a snapshot of this report on the screen right now, but most importantly, if you go to our website, fsdafrica.org, you will find the report there. This report goes beyond Eastern and Southern Africa, but obviously the partnership with OESAI was very, very helpful in informing this report. And then I would also like to invite you to the next webinar of this series. On the screen, you should see the invitation for that. So the next one is on 6 August, and this one will deal with specifically with digitization and insurtech in times of COVID, because we are seeing some very interesting developments in there. Yeah, some insurtechs seem to be benefiting from the social distancing in a lockdown environment. At the same time, they are also struggling with a few other things. So this will be on the 6th of August. Invitations will be sent out maybe by email through if you're subscribed to our newsletters, but certainly you will find the invitation page on fsdafrica.org. So to my panelists, thank you very much for taking time to attend this webinar. I really appreciate your contributions to this discussion, and I wish you all a very good afternoon and evening.
Thank you for having us, Thomas. Thank you. Bye.
Bye-bye.
Bye-bye.
Thank you. Bye.
Everybody.